So let's have a look then at what that means to the property sectors here in Brisbane. We'll start with the office sector. I guess when we think about the CBD and the near city markets, there's one issue that is at the front of our minds, and that is the construction cycle, which is just, well, really, we're part way through now. If we look at what's happened in 2008 in the near city market and 2009 in the CBD, you see an amount of construction activity which has created the second largest construction cycle in Australia's history. The only other one that was bigger was in the early 1990s in Melbourne, in 1990 and 1991, which is of course fueled very much by speculative building of very large office buildings. Thankfully in Brisbane, a large amount of the stock that was built was pre-committed, and it certainly stopped the rise in vacancy to the levels that we saw in the early 1990s. But fundamentally, it's going to take time to absorb this much stock coming into the market in such a short period of time. And of course, it's not over yet. The supply forecasts that we rely on are still quite influential in the outlook. We see a second peak of construction activity in 2011. Obviously, 111 Eagle is dominant in those numbers. And this is quite a protracted supply cycle, and this is what makes Brisbane different to the rest of Australia. Perth has a bit of this as well. Quite a protracted supply rather than all in 1 or 2 years. Balanced against the demand for space, we think fundamentally the amount of expansion in occupied floor space simply won't keep up with the amount of new space coming into the market. So that's what, of course, puts us into a higher vacancy situation. We think there'll be a second peak in vacancy in Brisbane CBD next year at just under 12%. And it's really not until 2012 that you start to see that vacancy rate coming down. And when you see that coming down, that's a signal that rents at least will stop falling, and we'll see potentially a rise start to occur again in rents. So this is very important, fundamentals for our CBD outlook. What it means to rents, we think the bulk of the adjustment in face rents has now occurred in Brisbane, but we do see a pretty flat environment over the next couple of years. It's really not until late 2012 that you start to see a slight rise again in the face rentals, and of course a fall in the incentives as well. Now a lot of people say to us, well, that's all fine, talking about total vacancy, but really the issue is around the prime market. And sure, it is in the prime market, exactly, because as you'll see here, we do forecast prime and secondary vacancy. And the second peak in vacancy in 2011 is caused by prime vacancy, of course, this new quality stock coming into the market. So we think the prime market will see the largest uptick in vacancy to just under 10% late next year, and the secondary market up to about 14% before both start to move down together from 2012. So what does it mean to the investment market? Well, I guess we've seen a sort of a gradual change in the nature and the attraction of investors through the Australian market over the last couple of years. In 2009, the focus was very much on Canberra. Give me safe assets, government tenants, long-term leases. There was an enormous amount of activity in Canberra. But 2010, the focus has shifted to the bigger, deeper markets and the markets that have the greatest potential to show rental growth in the short term. So no surprise that Melbourne and Sydney is right up there in the top of the investment activity so far this year. Brisbane has done okay. There's been a moderate amount of leasing of investment activity here. We think it's sort of a measure of selective investment activity for just the right assets so far in this cycle. What it means to pricing, we think, again, the bulk of the adjustment in rents has occurred, and the bulk of the adjustment in pricing has also occurred. We think that yield will be broadly stable now for the short term, and we think that by the end of next year, you may actually start to see some compression as the outlook actually becomes clearer and the better news gets closer, that is 2012, you'll start to see some measure of compression. And our forecast call for a 25 basis point pretty modest compression in yield that starts to add that capital value, about 3% next year, starting to step up after that. The secondary yield starts to move down a year after prime in our forecast. So let me just wrap that up and give you a summary of what we're saying here. We see there'll be stronger tenant demand in 2011, but it will be simply outweighed still by new supply options coming into the market. We see a sustained recovery really not occurring until 2012. Vacancy will tip up closer to 12% through late next year. a flat rental outlook, incentives broadly stable in the short term, and we see a small rise in value through the end of next year as we get closer to the stronger period of 2012. So I hope that gives you a bit of an idea of our outlook for the office sector in Brisbane. But to give it a bit more flesh and put more flesh on the bones, I'm pleased to introduce to the stage to talk about the investment market and the leasing market in more detail, Bill Tucker and David Price.